So, you're shopping for a mortgage, and you've seen the offer, right? Lenders dangling some instant cash back in one hand and a lower interest rate in the other. Both look pretty good, but one of them can save you tens of thousands of dollars. So which one is it? Let's break it down.
On the surface, it really feels like a classic dilemma. Do you take that immediate reward, cash in your pocket right now for moving, for furniture, or just to ease the pain of closing costs? Or do you play the long game with a lower rate that just quietly chips away at your payments for decades? It's a genuinely tough call.
Okay, so that leads us right to the big question. Which option truly leaves more money in your bank account when all is said and done? Is it the instant cash or those slow and steady savings from a lower rate? To figure this out, we can't guess. We've got to look at a real-world example.
To make this all feel a bit more real, let's follow the story of a first-time homebuyer who is staring down this exact decision.
So let's meet Sarah. She's found the perfect starter home, she's super excited, and she's ready to jump into the market. She's done her homework, she's saved up her money, and now she's navigating those final kind of stressful steps of getting her mortgage approved.
The home she's buying is priced at $350,000. It's a huge step, obviously, so she really wants to make the smartest financial decision possible here.
And Sarah's been really diligent about saving, so she's putting down a solid 20%. This is awesome because it helps her avoid something called private mortgage insurance, or PMI, which saves her money right out of the gate.
So after that down payment, her 30-year loan is going to be for $280,000. This number right here, that's the key to all our calculations.
All right, now her lender comes to her and basically presents two different paths. Option A has a 6.5% interest rate, but, and here's the shiny object, it comes with a 1% cashback bonus. That's $2,800 in her pocket at closing. Then there's option B, no cashback, but a lower interest rate of 5.875%. That cash sounds really tempting, doesn't it?
Okay, this is where we get to the heart of it all. We're going to put these two options head to head. We're going to run the numbers, no guesswork, no feelings, just a straight-up comparison to see which mortgage is the real financial winner.
So let's start with the most obvious thing, the monthly payment. With option A, the cashback offer, her payment is about $1,770 a month. With option B, the lower rate one, her payment drops to $1,656. And right there is a crucial number. By choosing the lower interest rate, Sarah would save $114 every single month. I mean, that's money she could be putting towards savings, investments, or just having a little extra breathing room in her budget.
Now, when you look at it here, you can kind of see why that cashback offer is so attractive. The difference is there, for sure, but it might not seem massive on a monthly basis. And that's the trap. Because the monthly payment is only one part of the story. The real cost is hidden over the long term. So to really see the impact, we have to zoom out, way out. Instead of looking at just 1 month, let's look at all 360 months of the loan. How much total interest will Sarah pay over 30 years with each of these options?
And wow, this chart just says it all. Look at this. With option A, the cashback mortgage, she'll pay around $357,000 in total interest. But with option B, that number plummets all the way down to about $316,000. I mean, the visual gap here is just staggering.
So here it is, the big reveal. Even after you subtract that $2,800 she got up front, Sarah would end up paying $41,000 more over the life of the loan, just to get that initial cash back. That free money ends up being incredibly expensive.
Now, look, to be fair, this doesn't mean cashback is always a bad deal. It's not a complete trap. There are a few very specific situations where it might actually be the right move for you. But, and this is key, they are the exception, not the rule. So when could it make sense? Well, first, if you are truly short on cash for closing costs and have no other way to cover them. Second, if you are absolutely confident you'll be refinancing to a lower rate in just a couple of years. And finally, if the rate difference is just tiny, like 0.1% or less. For most people who plan to stay in their home, though, the low rate wins, hands down.
So after all that, what's the single most important takeaway here? How can you actually apply this lesson to your own home buying journey to make sure you're making the smartest choice you possibly can? The answer is actually pretty simple. Don't guess. Please do not guess. Every mortgage offer is different. Your loan amount, the rates you're quoted, the cash back percentage,
all of it will change the outcome. You have to sit down and run the numbers for your specific scenario to see the real long-term cost.
Ultimately, it really all comes down to this one simple idea. That small bonus feels fantastic in the moment, but a mortgage is a marathon, not a sprint. The real prize is keeping tens of thousands of extra dollars in your pocket over the long haul. So the question to ask yourself is, are you going to focus on the small win today or the major victory tomorrow?